Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, if you are someone who's looking to retire at 40 and earn 1 lakh per month, then this segment is for you. On The Money Show today, we will tell you the strategies that you can use to earn a regular income from your mutual fund investments. Now, let's welcome on board Arnav Pandya, founder Money Edu School, and he'll be also answering your portfolio-related queries. Arnav, good evening and welcome to the show. We are going to talk about magic retirement, which if we assume one has to retire at the age of 40, how should one plan to get a regular income of at least 1 lakh per month after 40? Let's start with the exact age from where you need to start your investing or your investment journey, because if you're looking at retirement at around 40, which means you have, and if you don't have any other investments lined up or any other source of regular income, there are chances that you need to have an investment portfolio that will be enough for you for the rest of your lifetime. So at what age do you need to start investing, with what kind of amount?
Good evening. So, if you are wanting to retire early, which is around 40, there are multiple challenges at play. So, as far as the question goes as to when should you start investing and planning for this, I would say the day on which you start earning, it should be the day for which you plan for this. Because, see, if you wait even for a few years to plan for this kind of retirement, then the chances are that the amount which you will need to invest will balloon very significantly. So, just as an example, let me just look at this angle. So, for example, if you need, say, 1 lakh a month, which means that you will need at least 12 lakh a year as an income from your corpus. Now, for this kind of amount, according to me, at least a corpus of 4 crores is essential. Otherwise, the chances are that you will run out of your corpus in a very short period of time. So, if you want to accumulate that amount, and say you start at 30, and even if you do go in for and say an all equity portfolio with various mutual fund schemes, and you have an average rate of return of 12%, you will still need to invest 1.74 lakhs a month for you to reach this target. So this is one aspect of it. Now the question is that, can you lengthen the period? If you lengthen the period of investment, the amount which you need to invest each month will drop. But there is a practical problem with this, because
We'll have to just hold.
yes, you will need to have an aggressive approach where equity is a predominant asset class where the investment is made, because you need that in order to get the higher corpus by a young age. So that is one of the things. The other thing is also a practical difficulty, which is that, I mean, you cannot start very early also, because, I mean, there is only a certain age after which you start working and you start earning. So there is a limit to the time which is available for you also. The second and most important thing is that even if you do an aggressive bit of investing, you get a basic amount which will, say, for example, give you 12 lakhs of and out inflow a year. The real question would be that if you have stopped uh, this process at, say, 40, then you need that corpus to last you, which could be another 40 to 50 years. And the problem there is that, one, either you will need to budget for it aggressively, so have a very large corpus, so that even if a little bit of it is dipped into this corpus, you still don't run out of money. Because it could be that due to inflation, the amount which you thought is good enough for you to have a good standard of living, say, after 10 years, will not be the same after 20 years or 25 years. So that is a very important part of this entire process, and which is why retiring early looks a good in terms of a concept, but there are a lot of these practical difficulties which will keep cropping up.
All right, so let's talk about an ideal portfolio, maybe a model portfolio that one needs to have in order to have 1 lakh rupees per month when you retire at 40. So, what should be your ideal investment amount? And what should be the asset allocation and the diversification strategy across asset classes?
So if you want to have an inflow coming in of say 1 lakh a month, which is 12 lakhs a year, my working would show that, I mean, you need a portfolio of at least 4 crores, because only that is a figure which can sustain this kind of outflow. Now, in terms of an asset allocation mix, because of the fact that you have uh, a long way to go, even at this point of time, at least around 60% of the money has to be, say, in equity oriented assets. 20% can be in debt, and another 10% in gold and other precious metals, with another 10% coming in from alternative investments, which could be anything from real estate to other forms of investment. So if this is the kind of portfolio mix which you have, then you can still expect growth to keep happening in the portfolio, so that your withdrawals don't end up uh, ensuring that the corpus becomes less. Now, different people might want to tweak this figure a little bit, but the real issue remains that you will need a slightly more aggressive portfolio in order to ensure that, even though it's diversified across various asset classes, there is a bit of leeway there in terms of adding to the corpus.
This is the plan one needs to really focus on if retiring at 40 is something that you want to go for and also have a regular income. But we also have a lot of viewers who want to ask their questions, because there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria one should actually look at? So let's focus on our viewer queries. And if at all you are someone who's watching us live right now and has a question in mind, you can send us your query on our WhatsApp number, which is 865-797-4571. You can also email us your query on the Money Show at etnow.tv. So these are the details where you can directly get in touch with us. But then, Arnav, we have Subhash Shahani's question for you, and he wants to understand the tax implication for balance advantage funds post 31st March, which is from 1st April 2023 onwards. And he wants to understand if it is good to keep on investing in this category, and he is 76 years old.
So balanced advantage funds are dynamic asset allocation funds, whereby the fund manager decides how much money is going to go into equity, how much is going to go into debt, and how much will remain in cash. So the two principal asset classes which are there in that balanced advantage funds are debt and equity. The fund manager who manages the fund, they have their own uh, ratios and other workings, whereby they decide when to shift how much of the money from debt to equity or vice versa. Now, if you look at the actual position of balanced advantage funds which are in operation in the country, you see that on an average, more than 50%, so around between 55 to 60% is the normal equity component which is maintained by these balanced advantage funds. There are some balanced advantage funds which at some point take a high cash call also. But even when these funds take a higher cash call, the equity component still remains between 40 to 45%. Now, why is this important? This is important because the new guidelines for taxation of funds, which has come into which will come into effect from 1st April 2023, that says that any fund which has an equity component which is less than 35%, then those will be treated in a way whereby all gains will be considered as short-term capital gains, which means that all debt funds will fall into this category. Now, because balanced advantage funds, even though when they maintain a cash call, usually have more than 40-45% into equity, they are most likely to avoid falling into this new uh, way of calculation of tax. They are most likely to fall into the traditional way in which they were taxed, which is that if they maintain an equity component between 35 and 65%, then for them, the 3-year holding period will be the cutoff point for the gains to be long-term capital gains. And there the long-term capital gains will be taxed at 20% with the benefit of indexation. If a balance advantage fund goes beyond 65% and maintains it on an average for the year, then the calculation of tax will be as per equity oriented funds. So in those cases, those balance advantage funds will have a holding period of 1 year as the cutoff for conversion into a long-term capital gains, and their short-term capital gains will be 15%, long-term at 10%. So knowing the component of the equity in the balance advantage fund is very important, and most likely they will not fall into the debt taxation category.
All right, we move on to our next viewer query, and this is from Raman from Uttarakhand, and he has 4 debt funds in his portfolio. You have the fund details on you, I guess. So what should be his strategy?
So, see, the first worry which is there is that, is there any need to take any action before 31st March? Because that is the cutoff point after which the new taxation for debt comes into play. So, on this point, the rules are very clear. Any investment which is made before 1st April, that will still have the old way of taxation, which is that for these debt funds which are already held in the portfolio, a 3-year period is the cutoff point for conversion into long-term capital gains, and you will get the benefit of 20% with the indexation benefit coming in the calculation. So that much has to be clarified. The second part is all these debt funds, the query says that the returns over the last couple of years are 4-5%, and there is a reason for these, and that is that we have seen a rising interest rate environment not only in the country but across economies across the world. Now, when the interest rates are rising, bond prices move in the opposite direction, and which is why you find that the rate of return on the debt funds in the past 1.5 years has been pretty low because of these kind of rising interest rate environment. So now, in case there is some amount which is required for a particular goal for which these debt funds have been used, and you use that to get out of the debt fund, that is one thing. But otherwise, if the investor is able to continue, then these investments are fine, because what is also going to happen is that we are most likely at the peak of the interest rate hike cycle. Now, at some point over the next few months, it is most likely that the rate hikes will stop. And after a period of time, if the situation starts to improve, there might even be a slow amount of rate cuts coming in. Now, when that kind of situation happens, the situation as far as the returns of these debt funds are concerned, they will undergo a change. The pressure in terms of falling bond prices will stop, and when that happens, you will see that the average yield which comes into all these funds will also rise. So in that sense, if the investor doesn't need the money and is able to hold on, then they can continue, and in that sense, they will see a better situation, at least on the return front, in the next few years going ahead.
All right, so that's the answer for Raman. And on that note, thank you so much, Arnav, for being on the show and helping our viewers with all their financial planning strategies. And it's a sign off from me also. But then keep sending us your queries on our WhatsApp number and our email ID that will be flashing on the screen. Thank you so much for watching. Goodbye.